Hello, Investing Putts back with you, making a late night video. Wife's out of town, so what the hell. Market right now seems very driven by sector rotations. So here I've computed a best fit line to the stock price using 20 points in the past. So I've just plotted the slope of that best fit line. So this is basically just a smooth percent change in the stock price over the previous 20 days. I've plotted some of the spider sector ETFs against SPY, gold, and TLT. It's clear that the slope curves oscillate. It's also clear that some are peaking. Well, when some are peaking, some aren't, and some peak earlier than others. So maybe we're seeing rotations here, kind of in a more visualized form. So you can make the calculation in Google Sheets or Excel using the linest function, which does least squares linear fits to irregular data. So in this case, the data we supply is simply 20 days of past price data. And the linest function in Google Sheets by default spits out the slope and intercept of the best fit line. I'm only interested in the slope of that line, so I use the index function to extract the first element of the output, which is the slope. And the slope that's output from linest is the change in stock price per day. But what I really want is the percent change in price, so I can compare it to one stock to another. SPY that's $430 isn't going to compare well to XLE, which is $40 a share. So anyway, just to convert it to a percent change in price, I just divide it by the average price of the stock over some interval, and you can make a plot like this. So here's a result of doing the 20-day best linear fit to price data for XLE, which is the energy sector ETF. The jagged blue curve is the daily price data, while the red curve is the 20-day best fit slope. So for a given day, we look 20 days in the past and do a best fit to the price data, as I just mentioned, using the linest function. That's the 20-day period is kind of shown here with the thick black line. And then I associate the slope that I measure with the point on that blue curve, which is where the green arrow points. So I repeat the calculation for every day that I want to analyze. And notice how I'm missing some of the red line on the left side of the plot. And that's because I ran out of data. So I demand that I have 20 points in each best fit. Otherwise, I just ignore it. So with the benefit of hindsight, let's plot some turning points in the price action of XLE. I put red arrows where the price enters a downward trend and green arrows where the price enters an upward trend. And this is interpretive. So now the question is, does the slope of the best fit line have any predictive value, predictive power? Can we use the red line to pick future trends in the price action? That's what I'm trying to do some trend following here. So what does the slope data mean? If the slope is greater than 0, then it means that the trend of the price data is increasing, and vice versa. So here I've blocked off some time intervals when the slope is greater than 0. So you notice how the green blocks kind of reasonably match up to the turning points that I picked in the market. Maybe plus or minus a few days, but pretty close. There are very few false signals. I circled one false signal with a black oval. Okay, so you're probably asking yourself, why did you choose 20 days of data to compute the slope? And to be honest, I pulled that 20-day number out of the air. I set up a backtesting scheme where I can scan over many potential window lengths and see which produces the highest profit, weighted by the number of days in the market. So I'm scanning for the window length which provides the highest capital efficiency, so highest return per day. If I'm not in one stock, I want to be in another that's trending up. So that's why I don't just go for maximizing profit. I also want to, if the stock's not going sideways, I want to be in a different stock. So if you visually smooth through the noise, you can kind of convince yourself that there's a max profit around 40 days. So I'm choosing 40 days for my optimal window size for the slope calculation. So this is where backtested methods can get dodgy. I would hope to see a fairly smooth variation with a wide maximum, as we do see here. If the maximum is just one isolated value, then it's likely just caused by luck and probably won't work going forward. So here's the price slope attribute for XLE, now using a window of 40 days to compute the best fit line, whereas I used 20 days in some of the previous plots. So whenever the slope value is greater than 0, it's a buy signal. I like this method for this particular stock. If 40 days is a nice long window, because it's either on or off for an extended period of time. You know, XLE's obviously been a great performer this year, so it's been on for the most part. You can see there's more of the slope is above 0 than is off, but there's still plenty of time that's where it was kind of in a bear market, or not returning downward or sideways. So I don't want to be getting in and out of the market on a daily basis. So it's nice to have these kind of wide curves. All right, so here's the backtest result for XLE. The yellow curve is the stock price, and the blue curve is the backtested result. And again, using this 40-day window. So whenever the 40-day window slope is below 0, I'm out of the market. Whenever it's above 0, I'm in the market. So you can see with the blue curve, marches along with the stock price, and then it goes flat. That means we're out of the market. So net, we're able to get roughly the same performance as XLE over a year and a month, but we're only in the market maybe half the time. So when we're out of the market, presumably other sectors, the more typical sectors that aren't they're kind of counter-cyclical with energy, would be doing well, and we'd be in those and getting profits. So maybe we have maximized our capital efficiency here. I think the key to this working is the fact that big drawdowns rarely occur out of the blue. There's typically some stress prior to the big drop, but not always. So I highlighted XLE's worst drawdown in this data set. So in the 40 days leading up to that drawdown, notice that the trend was already downward. So we would have been out of the market some period of time before the big drawdown occurred. So this method will probably avoid drawdowns for the reason I just mentioned, but will it pick up the big outlier moves up? So if you look at studies from the past, it's great if you can call a market top and you're in cash. Hey, great, good for you. But if you're not in the market when you get the first huge climb out of a panic selling situation in a market crash, you get really hurt. You lose a lot of your performance by avoiding those big moves up. So anyway, this pink arrow shows one, the big move, one of the two big moves this year for XLE. The 40-day trend just happened to be positive in the days leading up to this big jump, so we would have been in the market. Was this luck or maybe something more fundamental? I don't know yet, but I'll find out. So, big picture, what am I trying to do here? I'm trying to tiptoe into the world of trend following. I swear I must have read, I think I've read 3 or 4 books on trend following, how great it is, how the world's smartest investors do trend following. And the stinking books, they don't tell you, there are no details whatsoever on how to actually follow the trend. So I assume there are some books that give their ideas on how to do it, but maybe it's something you have to figure out for yourself. So that's what I'm trying to do. I'm trying to see if I can kind of tease out longer period trends in the data and that are tradable and have some predictive power in the future. So we'll see. We'll see if I'm going to start trading this. I have 2 TD Ameritrade accounts, and the smaller one is where I'm doing my sector ETF stuff. So I think I'll probably do this in that account. It's only like a $14,000 account, so I don't have too much maneuvering room. But if it works, then maybe I'll use it in my main account, main play account, I should say. So anyway, kind of blathering on here, but I should just, as a disclaimer, point out I don't know what I'm doing. If you're here listening at this point, to your due diligence. I'm learning. I may end up being completely wrong. This may end up being just a load of crap. And if it is a load of crap, I'll tell you that. To my credit, at least I'll tell you that. So anyway, if you got comments or questions or reasons why I'm stupid and this won't work, post them in the comments. We're all here to learn. So we'll see you next time.